Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we're down 4 basis points and we have about 2 hours and 30 minutes left in trading on the 1 hour chart. We were on the overbought RSI and we seem to head lower as we've lost support on the 18 and 9 moving averages. As for the 4 hour chart, we have not reached overbought RSI yet, and we are still resting on support on the, I would say, the 9 moving average, and we also still have the 18 moving average support if we do head down lower. So on the daily chart, we appear to touch the recent highs since, I would say, since dating back to August 2nd. This is the nearest high that we've made since the down. And as for support, we do see that this, I would say, the 150-day moving average act as support as it was tested once, second time, and third time. And I'll mark that as our next support if we do head down lower in the next coming days. And as for resistance, ideally we need to break the 50-day moving average. That is our first resistance, and it seemed like we failed to do that today. And on a positive note, if we saw a convergence on the MACD, however, we need to see this daily MACD to turn positive. So if we were to move on higher, that price movement is roughly around, I would say, 70 basis points. Ideally, for this trend or sideways price action to end, we need to close above this yellow line or 50-day moving average for several days, ideally two or more days, and we may continue to see all-time high as well. And as for support, again, the 150-day moving average is a tested and well-supported floor that we've seen in the past or this month. So let's head to the forecast model. On here, I'll go day by day, where S&P 500 will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecasts we should focus on? Well, ideally, the trend that is the best match to the current trend. We have the current trend right here. And the trend in question, I believe, is the best match to the current trend is this. And this chart dates back to December 21st, 2006 to March 2nd or 22nd to 2007. So I'll point out why these two charts are similar. So what we have here in the beginning of the trend, we touched the bottom Bollinger Band, and then we proceeded to move on higher or a channel for several up channel for several days, and then we proceeded to break down right towards the second half, and I'll mark this since we're below the middle Bollinger Band. So let's tilt this slightly and let's make this pink, and then right towards the end we see it pop up a little bit above the middle Bollinger Band right towards the end, and let's just make this blue. So we start to see this pattern as well. We begin with bottom Bollinger Band right here, and then for several days we end up higher in the up channel right there, and right towards the second half we see it lose steam, and we start to see towards the end a pop above the middle Bollinger Band as well, same in the current trend. So what we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there is reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. Again, the trend that we just examined was December 21st, 2006 to March 22nd, 2007. and it looks like S&P 500 was down roughly around 80 basis points, so not much price movement. So we still may encounter sideways price action. And here's the current trend, and overlapping it is the 2006 to 2007 trend that we just examined, and they overlap pretty well. So that is all. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.